You spot a textbook double bottom pattern on the chart. You execute a buy order and place your stop loss just below the lowest point of the support line. Then the price dips slightly below your support line, hitting your stop loss and ejecting you from the trade right before it shoots upward without you. To the average trader, this precision reversal feels deeply personal. It looks like targeted manipulation by unseen forces hunting your exact position. The error here is confusing the map for the territory. Traders assume price is magnetically drawn to the two-dimensional geometric shapes they draw on their screens. A price chart only shows the aftermath of a conflict. To understand why a false breakout happens, we have to discard the chart and expose the invisible fuel powering the market: liquidity. This is the depth of market, or the DOM, the ledger showing the actual volume of orders waiting behind the standard price line. Those horizontal bars represent passive liquidity. They are limit orders waiting at specific price levels, acting as defensive walls. Against those walls, we have active liquidity. These are the aggressive market orders that initiate market movement. The mechanical rule of the market is simple. For a price to move to the next level, an active order must completely consume a wall of passive orders. If a price level has very few waiting limit orders, it takes only a small amount of active trading to chew through them and shift the price. A deep market packed with orders requires far more aggression to move. This mechanical consumption of orders is how massive financial institutions navigate the ecosystem. Institutional traders face a logistical dilemma. Their trades are so large that standard market execution would instantly devour all nearby orders, causing the price to move drastically against them before the trade is even finished. To solve this, institutions must find exceptionally thick pockets of liquidity to absorb their massive volume. They find it in latent liquidity, clusters of hidden stop-loss orders placed by thousands of retail traders in the same predictable spots. Those logical stop-losses below a double bottom form a massive, dormant pool of sell orders. The initial dip acts as a mechanical trigger. Hitting them unleashes a flood of sell orders, providing the exact passive liquidity institutions need to buy huge quantities without shifting price. What retail traders view as safe havens are actually predictable fuel depots harvested by large institutions to quietly enter the market. Institutional harvesting doesn't always require dramatic dives below major market lows. Often, the smart money moves through rough price action, the jagged staircase movements seen on the right, compared to the smooth line on the left. These jagged movements create minor liquidity pools along the way, acting as incremental stepping stones. These minor pools allow smart money to accumulate positions in stages. Because these small clusters of orders exist inside larger moves, liquidity functions as a fractal phenomenon, appearing in the same predictable patterns, whether you're looking at a minute or a month of data. One of the biggest myths in trading is the assumption that the market follows liquidity like a magnet pulling on price. Price actually moves toward the level where buyers and sellers find a new consensus on what an asset is worth. This point of agreement is the perceived value, and liquidity is simply the fluid medium price travels through to reach it. Framing the market as a simple war between smart money and retail traders is an oversimplification. False breakouts are frequently caused by intersecting agendas that ignore chart geometry entirely, like market makers hedging risk or algorithms rebalancing portfolios. The price chart never shows the intent or the cause behind a move. It only shows the final footprint of the conflict. Stop seeing charts as rigid walls of support and resistance. Instead, see an organic ecosystem where obvious patterns are merely pools of fuel waiting to be consumed as the market searches for true value.